When you look at a daily stock chart, it usually just looks like, well, a seismograph during a massive earthquake.
Oh, yeah. Just jagged lines everywhere.
Right, just these chaotic lines bouncing up and down, painted in red and green. It is incredibly easy to look at that screen and think it's all just random mathematical noise.
But it's not. I mean, every data point is driven by something real.
Exactly. When you zoom out and look closer, you realize every single one of those little spikes and dips is a human story.
And today, that story is just a bizarre, fascinating contradiction.
It really is. We are looking at a market where, on one hand, American consumers are suddenly getting massive payouts from the IRS.
Right.
And then AI companies are trying to build the future, but literally running out of physical hardware.
Yeah.
Plus, an international chip smuggling ring just wiped out a third of a major tech company's value.
It's a massive collision of human decisions, physical supply chains, and regulatory crackdowns all happening simultaneously.
Yeah, which sounds chaotic.
It does. But when you actually break down the mechanics of these events, the chaos of the market starts to make perfect logical sense.
And that is exactly what we are doing today. Welcome to our deep dive into the daily market briefing for March 21st, 2026.
Glad to be here for this one.
Our mission today is to cut through the overwhelming noise of today's massive market fluctuations. We want to help you understand the interconnected web of geopolitics, mixed economic signals, and the relentless AI boom.
Because it is all connected, even if it doesn't look like it at first glance.
Exactly. We are going to connect the dots so you can see the actual machinery moving beneath the surface. Okay, let's unpack this.
Let's do it.
Starting with the broadest view of the market's health. The overall picture of the U.S. stock market right now is, frankly, shivering.
Yeah, definitely a lot of anxiety out there.
For sure. The S&P 500 and the Dow Jones have both seen declines today, driven by this heavy cloud of uncertainty. But the biggest flashing red light in our sources today isn't actually the giant tech stocks.
No, it's not.
It's the Russell 2000.
Which is a really critical indicator for anyone who doesn't track it daily. The Russell 2000 is an index that tracks 2,000 small-cap companies.
Right. And today, it became the first U.S. benchmark to officially enter correction territory.
Yeah, and that is a very specific technical threshold. It basically means the index has fallen at least 10% from its recent peak.
So it's not a total crash, right?
No, not a total crash, but it is a highly meaningful pullback. It signals deeper structural issues in the economy.
And the briefing notes that this decline is primarily due to its sensitivity to the economic cycle and oil prices, which ties directly into the ongoing geopolitical situation in Iran.
Absolutely. The tensions there have a direct and immediate impact on global trade and oil futures.
We also have Federal Reserve Governor Waller coming out today and urging caution. He's hinting that interest rate cuts might be possible later in the year, but strictly depending on how these economic developments play out.
Right. The Fed is in a really tough spot of waiting and watching.
I was actually thinking about this dynamic on the way into the studio. I look at the Russell 2000 kind of like the canary in the coal mine for the U.S. economy.
That's a great way to put it.
While the S&P 500, which is made up of these massive multinational corporations, is more like a giant elephant. But here is my pushback.
Okay, let's hear it.
If the canary has fainted, how does the elephant keep moving? Don't these massive companies rely on the smaller ones? Or are the giants just totally insulated from these oil and rate shocks?
If we connect this to the bigger picture, the difference in vulnerability really comes down to the mechanics of debt and profit margins.
Okay, break that down for me.
Let's look at that canary. A small-cap company in the Russell 2000, say, a regional logistics firm, or a mid-sized manufacturing plant, operates on incredibly razor-thin margins.
Right, they don't have billions in the bank.
Exactly. They are highly dependent on the domestic economy, and crucially, they are incredibly reliant on borrowing money to fund their daily operations or to build new facilities.
So when the Federal Reserve keeps interest rates high, that cost of borrowing money hits their balance sheet immediately.
Yes. It's not a theoretical future problem. It's a today problem. It is suffocating them right now because their cost of capital has skyrocketed.
Wow, yeah.
Now, add in a spike in oil prices due to the geopolitical tensions in Iran. Suddenly, it cost that regional logistics firm significantly more money just to fuel their trucks.
And power their warehouses.
Exactly, and to service their debt. They feel the pinch in real time, which leads to immediate sell-offs in their stock.
Okay, so what about the elephant?
Right, contrast that with the S&P 500 giants, particularly in the tech sector.
Ah.
They are sitting on absolute mountains of cash.
Oh, right. So they don't need to borrow at these high rates?
No, they aren't borrowing money at 7% to keep the lights on. In fact, they're often earning high interest on the massive cash reserves they already hold.
Ah, so the high rates actually benefit their cash pile.
Precisely. So while the canary is choking on the toxic air of high borrowing costs and supply chain shocks, the elephant is walking around with its own private oxygen tank.
Wait, but if those small cap logistics companies and regional manufacturers are drowning in debt and scaling back their operations, how are the big tech companies physically moving their servers?
That's the million-dollar question.
I mean, how are they getting their products onto shelves? The elephant might have an oxygen tank, but it still needs to walk on the actual ground. Doesn't the pain eventually travel upward?
Yes, and that is the exact tension Federal Reserve Governor Waller is monitoring right now. It's exactly why he is urging caution today.
Because the giants are only insulated in the short term.
You're absolutely right. Eventually, if the small caps start collapsing, it leads to severe supply chain bottlenecks.
And layoffs, right.
Exactly. Those companies start laying off workers, which leads to job losses, which leads to less consumer spending. And a drop in consumer spending ultimately hits the bottom line of the giants in the S&P 500.
So the Fed is watching that canary very closely.
Extremely closely. They are trying to decide the exact right moment to pump some fresh air in the form of rate cuts into the mine before the damage spreads upward to the rest of the economy.
Which brings us to the actual people out there spending money, because while the Fed watches the canary, the average consumer seems to be playing an entirely different game.
Oh, completely. The data is wildly contradictory right now.
Yeah, if you look at the economic data on the ground right now, it is a massive, confusing tug of war.
It really is.
Corporate earnings reports are coming in incredibly mixed, which is driving further market volatility. We are seeing some indicators pointing straight toward an economic slowdown.
Driven by the inflation and high interest rates we just discussed.
Exactly. But then other indicators suggest the economy is actually still expanding. And here's where it gets really interesting.
Oh, the tax data.
Yes. There is one major, completely surprising data point in our sources today regarding the IRS.
Right, the tax refunds.
Yay.
According to new filing data, the average IRS tax refund is up a staggering 10.8%.
Nearly 11%. That is a massive jump.
It's huge.
And we have to look at why that is actually happening, because from an economic perspective, this is often the delayed result of inflation.
Yeah, the tax code playing catch up.
Right. The IRS adjusts standard deductions and tax brackets upward to account for the rising cost of living. So if your wage growth cool off this year, but those inflation adjustments were locked into the tax code.
You suddenly find that a much larger chunk of your income is shielded from taxes.
Exactly. The result is a much bigger refund check hitting your bank account in the spring.
That is a critical underlying mechanism.
Hmm.
It is the tax code structurally reacting to the inflation of the past few years, which results in a sudden, massive injection of liquidity into millions of households.
Which basically acts like an unexpected stimulus check for the entire country.
It really does.
So I have to challenge this whole doom and gloom economic slowdown narrative.
Go for
If I'm listening to this on my commute right now, I'm probably thinking, wait a second. My groceries are wildly expensive. My credit card interest is punishing me.
Right.
But we aren't in a recession because everyone just got a massive payout from the IRS. How does that work?
Well, it highlights exactly why the markets are experiencing such wild fluctuations right now.
Yeah.
You have this intense, unresolved tension between long-term systemic headwinds and short-term consumer cash injections.
So the headwinds are what's pulling things down.
Right. The long-term headwinds are inflation eroding your purchasing power over time and high interest rates making mortgages and car loans painfully expensive.
Right, the stuff we feel every day.
But, as you pointed out, you have this sudden jolt of liquidity. A 10.8% increase in a tax refund is not a trivial amount of money.
No, not at all.
For millions of households, that is the difference between scraping by and having a few thousand extra dollars in their checking account.
And consumers generally do not hoard that money. They go out and spend it.
Exactly. They buy a new appliance, they book a summer vacation, or they pay down high-interest credit card debt.
Which then frees up even more of their monthly income.
Yes. This sudden burst of consumer spending acts as a powerful counterweight to the economic slowdown. It actually props up corporate earnings for a quarter or two.
But I'm guessing the Federal Reserve looks at everyone buying new refrigerators with their tax refunds and absolutely panics, right?
Oh, they certainly don't celebrate it.
Right.
Because if consumers keep spending heavily, demand stays high.
Right.
And if demand stays high, companies can keep raising prices, meaning inflation refuses to come down.
So the Fed sees that extra spending and hits the brakes.
Exactly. The Fed looks at that 10.8% increase in refunds and thinks, well, we cannot safely cut interest rates yet because the consumer is still spending too much.
Wow. It creates an incredibly frustrating feedback loop of mixed signals.
It's a headache for everyone involved. The market doesn't know whether to price in a recession, an economic boom, or a scenario where inflation just stays sticky forever.
That is a complete macroeconomic paradox. The very thing that helps the consumer in the short term, a big tax refund, might actually prolong the high interest rates that are hurting them in the long term.
It is a perfect storm of contradictory data.
All right, so we have the broader economy locked in this messy, complicated tug of war, but we have to look at the other side of the market now.
The tech side.
Yes. Because while the average consumer is figuring out how to spend an unexpected tax refund, the corporate giants sitting on those mountains of cash have only one thing on their shopping list.
AI?
Exactly. We are looking at tech, specifically the artificial intelligence sector, which is violently defying all laws of economic gravity right now.
It is the undeniable engine of the current market. I mean, the sheer scale of growth, the data centers being built, the investment flowing in it is staggering.
And Nvidia is highlighted once again in our briefing as a standout performer and top gainer.
Unsurprising.
Right. They're completely dominating the hardware infrastructure space for AI, while companies like OpenAI are leading the charge on the software and model training side.
But there is a massive catch.
Yes. According to our sources, this unstoppable force is hitting a massive physical, real-world roadblock. There is a severe memory chip shortage.
Yeah, a huge bottleneck.
Companies like Micron and Samsung are apparently scrambling to address this issue. So what does this all mean? Let me make sure I understand the mechanics of this.
Sure.
It feels like we are trying to build the most advanced, high-performance fleet of race cars in human history, these massive AI data centers.
Okay, good analogy.
But we are completely running out of tires. Could a physical lack of memory chips actually derail this entire digital gold rush?
What's fascinating here is the stark contrast between the limitless ambition of software and the unforgiving, strict limitations of physical hardware and global supply chains.
Yeah, we forget about the physical stuff.
Exactly. When we talk about AI, we use very ethereal, floaty words. We talk about the cloud or neural networks or large language models.
Right.
It sounds intangible.
Right, it sounds like it just exists in the air around us, like magic.
But it doesn't.
Yeah.
Artificial intelligence is arguably the most resource-intensive technology humanity has ever created.
Wow.
Those Nvidia GPUs, the incredibly expensive engines of your race cars, they process mind-boggling amounts of data, but they cannot do it alone.
They need the tires.
They require a highly specific type of high-bandwidth memory to feed them that data fast enough to actually function. That memory chip is the tire on the track.
So what happens if they don't have it?
If the memory isn't there, the
Yeah.
GPU just floods. It can't operate at capacity. So essentially, a $30,000 piece of hardware becomes a very expensive paperweight because it's missing a crucial, smaller component.
But why can't we just make more tires? I mean, Micron and Samsung are massive multinational corporations with almost unlimited resources.
Right.
If the demand is there, why is the supply chain failing?
Because you cannot just spin up a new semiconductor fabrication plant overnight. These are some of the most complex, highly engineered manufacturing facilities on Earth.
Like, how complex are we talking?
They cost tens of billions of dollars and take years to build. The clean rooms required are orders of magnitude cleaner than a hospital operating room.
Oh, wow.
Yeah, and the machines that print these chips use extreme ultraviolet lasers to etch patterns onto silicon wafers at the atomic level.
Mm-hmm.
It is precision engineering on a scale that is genuinely hard to comprehend.
So when the entire world suddenly decides, simultaneously, that they need 10 times more AI computing power.
The software can theoretically scale infinitely, but the physical hardware hits a brick wall.
Which means the shortage is structural. It isn't just a shipping delay at a port, it's a fundamental limit on human manufacturing capacity.
Exactly.
The digital gold rush is suddenly gated by who can actually get their hands on the physical pickaxes and shovels.
And that physical bottleneck dictates the pace of the entire AI revolution. If companies can't get the hardware, they can't train their next generation AI models on time.
And as we know from history, whenever there is a massive gold rush and a severe shortage of tools, people start bending the rules.
Oh, absolutely.
Which brings us to the dark side of this incredible technological boom. Section 4 of our briefing today reads less like a financial report and more like an absolute Wild West novel.
It really does. The sheer amount of money pouring into tech right now is straining corporate governance to its absolute breaking point.
Friction is putting it lightly. Listen to this. Super micro shares tanked a staggering 33% today.
Just a brutal drop.
1/3 of a major company's value wiped out in a single trading session. Why? Because employees were charged with smuggling Nvidia chips to China.
Yeah.
Let's break down how something like that actually happens. When you hear smuggling tech hardware, are they stuffing microchips into the false bottom of a suitcase? How are employees moving enterprise-grade server equipment across international borders illegally?
Well, while it sounds like a spy movie, the reality is usually a complex paper trail of corporate shell companies.
Oh, so it's a paperwork crime?
Mostly, yes. The United States has enacted strict geopolitical export restrictions on these high-end AI chips to prevent foreign adversaries from gaining a technological edge.
Right, national security stuff.
Exactly. To bypass those laws, smugglers will often falsify export documents. They will officially sell the hardware to a seemingly legitimate buyer in a neutral third-party country.
So it looks completely legal on paper.
Right. But once the chips arrive there, they are silently rerouted and shipped to buyers in China who are willing to pay astronomical black market prices due to the scarcity we just talked about.
So the financial upside is so absurdly high that people are willing to risk federal prison to facilitate it?
Yes, the incentives are just warped.
And the market reaction, a 33% drop, shows that investors are terrified of the government stepping in and heavily sanctioning Supermicro for a failure of internal oversight.
It's a massive liability.
But the lack of corporate accountability doesn't stop at hardware smuggling. We also have the news today that Elon Musk has been found liable for misleading Twitter investors ahead of his $44 billion acquisition of the platform.
Yeah, and this is a crucial development in market regulation.
Break that down for us.
When a high-profile figure like Elon Musk is accumulating a massive stake in a company, there are strict rules about when and how that must be disclosed to the public.
You can't just do it in secret.
Exactly. If you delay filing those required disclosures or make misleading public statements, you artificially suppress the stock price.
Which allows you to buy more shares cheaply.
Exactly. While the people selling those shares miss out on the premium they would have gotten if the market knew your true intentions.
So the legal system is stepping in to quantify that damage. It's the courts reinforcing the idea that no matter how wealthy you are or how revolutionary your other tech companies might be, the fundamental rules of investor transparency still apply.
Right, you cannot manipulate the market without consequences. It's an attempt to maintain a level playing field.
So you have international hardware smuggling on one hand and $44 billion lawsuits over transparency on the other.
This raises an important question, doesn't it?
It really does. It feels like tech desperately needs some guardrails right now. Does tech need to be saved from itself?
Well, we are actually seeing regulators step in to upgrade the system.
Right, like with NASDAQ. The SEC has just approved NASDAQ's tokenized settlement pilot. Now, I know tokenized settlement sounds like incredibly dense financial jargon.
It does sound intimidating.
What does that actually mean for the everyday functioning of the market?
Simply put, a tokenized settlement is using blockchain technology to modernize the plumbing of the stock market.
Okay.
Right now, when you click buy on a stock, the transaction looks instant on your screen. But behind the scenes, it actually takes a couple of days, known as T+2 settlement, for the money and the shares to officially change hands through various clearinghouses.
T+2, got it. And that multi-day delay creates counterparty risk.
Exactly.
Meaning, what if one of the parties goes bankrupt in those 2 days before the trade officially clears?
Precisely. It happens. By using a digital token on a blockchain, the SEC and NASDAQ are testing a way to remove the middlemen and make that settlement instantaneous and perfectly trackable.
Oh, wow. So it settles in seconds, not days.
Right. It dramatically reduces the chance for fraud, systemic failure, or the kind of accounting discrepancies that cause market panic.
It's the regulators finally upgrading the underlying infrastructure to keep up with the speed of modern trading.
Long overdue, honestly.
And speaking of regulators, that leads us to the final and perhaps most impactful piece of news today. The Trump administration has unveiled a national AI policy framework.
This is a massive development.
It is. Now, before we dive into the mechanics of this, I want to make it crystal clear to you listening. We are not taking a political side here.
Absolutely not.
Our job on this deep dive is never to endorse or condemn a political platform. We are impartially looking at the stated goals in our briefing, which are limiting state power and promoting innovation in the AI sector, and we are just analyzing the potential market impact of those specific rules.
Right. This policy framework raises a fundamental question about how governments should interact with the technology that is evolving way faster than the law can keep up.
So what does it mean for the market?
In market terms, a stated goal of limiting state power generally translates to a deregulatory or light touch approach.
How does that actually play out for the companies building these models? Does it mean they can bypass certain safety checks?
In practice, it often means stripping away bureaucratic red tape. For example, it might involve removing stringent, government-mandated safety testing requirements before a new AI model can be released to the public.
Okay, so a faster runway to launch.
Exactly. Or it might mean prioritizing tax incentives for research rather than creating a massive new federal oversight agency. The theory driving this approach is that less state intervention allows domestic companies to innovate faster.
And deploy products quicker.
Right. And maintain a competitive dominance globally, particularly against international rivals.
So for a company like OpenAI or Nvidia, they might look at that framework and see a massive green light.
Oh, absolutely.
They can keep pouring billions into research and pushing the boundaries what these models can do without the fear of a government agency suddenly hitting the brakes and demanding a 6-month review process.
That is the market calculus, yes. But it is an incredibly delicate tightrope walk.
How so?
Well, if the regulations are too loose, you risk unchecked monopolies, ethical breaches, or the exact kind of black market chip smuggling we just discussed.
Right.
But if the regulations are too tight, you stifle the very innovation that is currently propping up the broader stock market. The government is essentially trying to write the rules for a game that changes every single day.
It really is the Wild West. You have prospectors mining for digital gold, you have outlaws smuggling the pickaxes, and you have the sheriffs finally riding into town trying to establish some semblance of order without killing the boomtown.
That's a great summary.
Okay, we have covered a massive amount of ground today. We started deep in the macro economy, looking at how the Russell 2000 is acting as our canary in the coal mine.
Feeling the immediate suffocation of high interest rates and oil prices.
Exactly, while the Federal Reserve watches and waits. Then we explored the paradox of the consumer economy, where a structural inflation adjustment led to a 10.8% increase in IRS tax refunds.
Which is acting like a stealth stimulus package that keeps demand hot.
Right. And from there, we looked at the physical bottlenecks of the digital world. The realization that the boundless ambition of AI software is currently crashing into a very real, very physical shortage of high-bandwidth memory chips.
We are building the race cars, but we are running out of tires.
Exactly. And finally, we saw how that incredible demand and scarcity is warping corporate behavior. It is leading to international chip smuggling to bypass export controls, massive stock drops, legal liabilities over market manipulation.
And a brand new wave of government regulation from the SEC and the White House trying to wrangle this beast.
Yes. And for you listening, I want to remind you why we dig into this stuff. These market movements, as abstract as they can sometimes feel when we're talking about basis points and tokenized settlements, they really matter.
They impact daily life.
They dictate the cost of the groceries you buy. They determine the safety and growth of your retirement investments. And with this AI boom, they are literally writing the rules for the future of the technology you use every single day.
The stakes have genuinely never been higher. Which actually leaves me with a final thought today.
Let's hear it.
We spent so much time marveling at the software. We look at the intelligence and the capabilities of these new AI models, and it just feels like magic.
It does.
But considering everything we unpacked today, from the absolute reliance on tiny, difficult-to-manufacture memory chips, to the geopolitical tensions restricting their movement, to the new policies coming out of Washington,
Yeah.
I think it's worth asking, if the future of artificial intelligence relies on a fragile, highly regulated physical supply chain that people are now willing to smuggle across borders,
Yeah.
are the biggest risks to the AI revolution actually political and physical rather than technological?
Wow, that is definitely something to chew on. The code might be flawless, but the physical world it relies on is incredibly messy.
Very messy.
Thank you so much for joining us on this deep dive. We always appreciate you taking the time to explore these complex stories with us, and we will catch you next time as we continue to unpack the forces shaping our world.